Welcome back to Bonnie's Life, where we transform complex financial concepts into actionable knowledge that can change your trading game forever. I'm Bonnie, and today we're diving deep into something that separates the crypto winners from the losers: the art and science of reading cryptocurrency charts like a seasoned professional. Let's start with a reality check that might surprise you. According to the latest research from Token Metrics, 82% of professional crypto traders now use AI-powered tools in their analysis. But here's the kicker: every single one of them still relies on fundamental chart reading skills. Why? Because artificial intelligence can process data faster than any human, but it takes human intuition to understand market psychology and context. The cryptocurrency market operates 24 hours a day, 7 days a week, with a combined market capitalization that fluctuates by billions of dollars daily. Unlike traditional stock markets that close for weekends and holidays, crypto never sleeps. This creates unique opportunities and challenges that make chart reading not just useful, but absolutely essential for anyone serious about crypto trading. Dr. Sarah Chen, a quantitative analyst at Harvard Business School who specializes in cryptocurrency markets, recently told Bloomberg that the ability to read charts in crypto is like having a conversation with the market itself. The charts tell you not just what happened, but what thousands of traders are thinking and feeling in real time. Let's start with the fundamentals, because even the most sophisticated trading strategies are built on these basic principles. When you look at any cryptocurrency chart, you're essentially looking at a visual representation of human emotions: fear, greed, hope, and panic, all translated into price movements. The first thing you need to understand is time frames. Professional traders don't just look at one time frame. They analyze multiple time frames to get a complete picture. Think of it like looking at a building. You need to see the foundation, the structure, and the details all at once. For beginners, I recommend starting with the daily chart to understand the overall trend, then moving to the 4-hour chart for medium-term analysis, and finally, the 1-hour chart for precise entry and exit points. This approach, recommended by professional traders at Stock Hero, one of the top AI trading platforms for 2025, gives you context without overwhelming you with noise. Now let's talk about candlesticks, the building blocks of chart analysis. Each candlestick tells a story about the battle between buyers and sellers during a specific time period. The body of the candle shows you the opening and closing prices, while the wicks show you the highest and lowest prices reached during that period. A green or white candle means the price closed higher than it opened. The bulls won that round. A red or black candle means the price closed lower than it opened. The bears took control. But here's where it gets interesting. The size and shape of these candles tell you much more than just who won or lost. Now that you understand the basics, let's dive into the tools that professional traders use every single day. According to Candlesticks' latest analysis of successful crypto traders, there are 5 indicators that consistently appear in the toolkits of profitable traders. Moving averages, the trend's best friend. Moving averages are like the North Star of technical analysis. They help you navigate through the noise and identify the true direction of the market. The most commonly used moving averages in crypto trading are the 20-period, 50-period, and 200-period moving averages. Here's a professional tip that most beginners miss. When the price is above the moving average, the trend is generally bullish. When it's below, the trend is bearish. But the real magic happens when these moving averages interact with each other. When a shorter period moving average crosses above a longer period one, it's called a golden cross, a powerful bullish signal. When it crosses below, it's a death cross, a bearish warning. Michael Novogratz, the CEO of Galaxy Digital and one of the most respected voices in crypto, recently stated in a CNBC interview that moving averages are the backbone of any serious trading strategy. They cut through the emotional noise and show you what the market is actually doing, not what you hope it's doing. RSI, the market's mood detector. The Relative Strength Index, or RSI, is like having a thermometer for market sentiment. It measures the speed and magnitude of price changes on a scale from 0 to 100, helping you identify when an asset might be overbought or oversold. Here's how professionals use RSI. When it's above 70, the market might be overbought, suggesting a potential pullback. When it's below 30, the market might be oversold, indicating a possible bounce. But, and this is crucial, never use RSI in isolation. A 2023 comparative study published in the Journal of Economic Sciences found that RSI shows better performance than MACD in crypto markets, but only when combined with other indicators. Dr. Andreas Antonopoulos, author of Mastering Bitcoin and a leading blockchain expert, explains it perfectly. RSI doesn't predict the future, it tells you about the present momentum. Smart traders use it to time their entries and exits, not to make buy or sell decisions. MACD, the Momentum Master. The Moving Average Convergence Divergence, or MACD, is like having a sophisticated radar system for detecting changes in momentum before they become obvious to everyone else. It consists of three components: the MACD line, the signal line, and the histogram. Professional traders watch for MACD crossovers. When the MACD line crosses above the signal line, it's often a bullish signal. When it crosses below, it's bearish. But here's the advanced technique. Divergences between MACD and price action often signal trend reversals before they happen. According to research from Token Metrics, MACD divergences have shown a 68% accuracy rate in predicting Bitcoin trend reversals over the past 2 years. That's not perfect, but it's significantly better than random chance. Bollinger Bands, the volatility whisperer. Bollinger Bands are particularly powerful in crypto trading because they adapt to volatility. And if there's one thing crypto markets have in abundance, it's volatility. These bands expand and contract based on market volatility, creating a dynamic framework for understanding price action. When the bands are wide, volatility is high. When they're narrow, volatility is low. And this often precedes significant price movements. Professional traders call this the squeeze, and it's one of the most reliable setups in crypto trading. John Bollinger himself, the creator of Bollinger Bands, recently commented on crypto applications. Cryptocurrency markets are perfect for Bollinger Bands because they exhibit the kind of volatility clustering that makes the bands most effective. The key is understanding that the bands are not support and resistance levels, they're probability zones. Volume, the truth detector. Volume is perhaps the most underrated indicator among beginner traders, but professionals know it's absolutely crucial. Volume confirms price movements. When price moves with high volume, the move is more likely to continue. When price moves with low volume, it's more likely to reverse. Here's a professional secret: always look for volume spikes at key support and resistance levels. High volume at these levels often indicates institutional involvement, which can lead to significant price movements. Support and resistance, the market's psychological battlegrounds. Now let's talk about support and resistance, concepts that are absolutely fundamental to successful crypto trading. These aren't just lines on a chart. They represent psychological levels where buying and selling pressure intensifies. Support is a price level where buying pressure is expected to be strong enough to prevent further decline. Resistance is a price level where selling pressure is expected to be strong enough to prevent further advance. But here's what separates professional traders from amateurs. They understand that support and resistance are zones, not exact prices. According to analysis from CryptoHopper, one of the leading crypto trading platforms, support and resistance levels become stronger when they're tested multiple times. Each test that holds increases the psychological significance of that level. Peter Brandt, a legendary trader with over 40 years of experience, who's become increasingly active in crypto markets, explains it this way. Support and resistance in crypto markets are like magnets. Price is drawn to these levels, and the more times they're tested, the stronger the magnetic pull becomes. Chart patterns. Reading the market's body language. Chart patterns are like the market's body language. They reveal the underlying psychology of traders and often predict future price movements. Let's explore the most reliable patterns that professional crypto traders use. Reversal patterns. When trends change direction. The head and shoulders pattern is one of the most reliable reversal patterns in crypto trading. It consists of 3 peaks, with the middle peak, the head, being higher than the other 2, the shoulders. When this pattern completes, it often signals a significant trend reversal. The inverse head and shoulders works in the opposite direction, signaling a bullish reversal after a downtrend. According to data from TradingView, head and shoulders patterns in major cryptocurrencies have shown approximately 70% reliability over the past 3 years. Double tops and double bottoms are equally important reversal patterns. A double top occurs when price reaches a high, pulls back, then reaches approximately the same high again before declining. This pattern suggests that buyers are losing strength and a reversal may be imminent. Continuation patterns. When trends take a breather. Triangle patterns, ascending, descending, and symmetrical, are among the most common continuation patterns in crypto markets. These patterns represent periods of consolidation before the trend resumes. An ascending triangle typically forms during an uptrend and suggests the trend will continue higher. A descending triangle forms during a downtrend and suggests further decline. Symmetrical triangles can break in either direction, making them trickier to trade. Flags and pennants are short-term continuation patterns that often occur after strong price movements. They represent brief pauses before the trend resumes in the same direction. Advanced techniques. Thinking like a professional. Now that you understand the basics, let's explore some advanced techniques that separate professional traders from the crowd. These are the methods used by traders at firms like Galaxy Digital, Coinbase, and other institutional players. Multi-time frame analysis, the professional's edge. Professional traders never make decisions based on a single time frame. They use what's called top-down analysis, starting with longer time frames to identify the overall trend, then moving to shorter time frames for precise entry and exit points. Here's the professional approach. Use the weekly chart to identify the long-term trend, the daily chart for intermediate-term analysis, the 4-hour chart for short-term bias, and the 1-hour chart for entry timing. This approach, recommended by analysts at Bitwise Asset Management, helps you stay aligned with the bigger picture while optimizing your entry and exit points. Volume profile, the institutional perspective. Volume profile analysis is an advanced technique that shows you where the most trading activity has occurred at different price levels. This creates a 3-dimensional view of the market that reveals hidden support and resistance levels. High-volume nodes often act as strong support or resistance levels because they represent prices where many traders have positions. When price returns to these levels, it often finds significant buying or selling interest. Divergence analysis, spotting trend changes early. Divergence occurs when price action and technical indicators move in opposite directions. This often signals that a trend is losing momentum and may be about to reverse. Bullish divergence occurs when price makes lower lows while an oscillator like RSI makes higher lows. Bearish divergence occurs when price makes higher highs while the oscillator makes lower highs. According to research from the University of Cambridge's Crypto Trading Lab, divergences have shown a 65% success rate in predicting trend reversals in major cryptocurrencies. Risk management, the professional's secret weapon. Here's something that might surprise you. The difference between profitable and unprofitable crypto traders isn't their ability to pick winners. It's their ability to manage risk. Professional traders understand that risk management isn't just about stop losses. It's about position sizing, portfolio allocation, and emotional control. Position sizing, the mathematics of success. Professional traders never risk more than 1 to 2% of their total capital on any single trade. This might seem conservative, but it's what allows them to survive the inevitable losing streaks that every trader faces. Here's the math. If you risk 2% per trade, you can have 50 consecutive losing trades before losing your entire account. If you risk 10% per trade, you can only have 10 consecutive losses. In crypto markets, where volatility can be extreme, this conservative approach is what separates professionals from gamblers. Stop loss strategies, your insurance policy. Stop losses are like insurance policies for your trades. You hope you never need them, but you're grateful they're there when you do. Professional crypto traders use several types of stop losses depending on market conditions. Technical stop losses are placed below support levels for long positions and above resistance levels for short positions. Percentage stop losses are fixed percentages from your entry price. Volatility-based stop losses adjust for market conditions using indicators like average true range. Current market analysis, applying what we've learned. Let's apply these concepts to the current crypto market conditions. As of August 2025, Bitcoin is trading approximately 10% below its all-time high, facing resistance around the $110,000 level. This presents an excellent case study for applying our chart reading skills. Looking at the daily chart, we can see that Bitcoin has formed a potential double top pattern around the $120,000 level. The RSI is showing bearish divergence, suggesting that momentum is weakening despite the high prices. The MACD is beginning to turn negative, confirming the momentum shift. However, the weekly chart still shows Bitcoin in a strong uptrend, with the 20-week moving average providing support around $95,000. This multi-time frame analysis suggests that while short-term weakness is possible, the long-term trend remains bullish. Volume analysis reveals that the recent selling has been on relatively high volume, suggesting institutional involvement. This could indicate either profit-taking by large holders or accumulation by new institutional investors at lower levels. Expert insights, learning from the professionals. Let's hear from some of the most respected voices in crypto trading about their approach to chart analysis. Raoul Pal, former Goldman Sachs executive and founder of Real Vision, recently shared his perspective. In crypto markets, technical analysis is even more important than in traditional markets because we don't have the same fundamental anchors. The charts become the primary language for understanding market sentiment and positioning. Willy Woo, a respected on-chain analyst and trader, emphasizes the importance of combining technical analysis with on-chain metrics. Traditional technical analysis works in crypto, but it's even more powerful when combined with blockchain data. The charts show you what traders are thinking, but on-chain data shows you what they're actually doing. Katie Stockton, founder of Fairlead Strategies and a leading technical analyst, notes, crypto markets are particularly responsive to technical analysis because they are driven primarily by sentiment and momentum rather than fundamental valuation metrics. This makes chart patterns and indicators especially reliable. Regulatory perspectives, the changing landscape. The regulatory environment for cryptocurrency trading is evolving rapidly, and this has important implications for chart analysis and trading strategies. The recent White House Crypto Policy Report and the passage of the Genius Act are bringing increased clarity to the market. According to legal experts at Latham & Watkins, the increasing regulatory clarity is likely to reduce volatility over time as institutional participation increases. This could make traditional technical analysis even more reliable as crypto markets mature. However, traders need to be aware that regulatory announcements can cause significant short-term volatility that may temporarily invalidate technical signals. Professional traders always keep an eye on the regulatory calendar and adjust their strategies accordingly. Technology integration, the future of chart analysis. The integration of artificial intelligence and machine learning into chart analysis is revolutionizing how professional traders approach crypto markets. According to recent data, 88% of trading executives are increasing their AI-related budgets in 2025. Platforms like Token Metrics are using AI to identify patterns that human traders might miss, while still relying on fundamental technical analysis principles. The key is understanding that AI enhances human analysis rather than replacing it. ChatGPT agents can now automate many routine chart analysis tasks, but professional traders emphasize that human judgment remains crucial for interpreting results and making final trading decisions. Practical application: your 24-hour trading plan. Based on current market conditions and the techniques we've discussed, here's a practical trading approach for the next 24 hours. Remember, this is educational content, not financial advice, and you should always do your own research and consider your risk tolerance. For Bitcoin, watch the $108,000 level as immediate support. A break below this level with high volume could signal further weakness toward $105,000. Resistance remains at $112,000, with a break above potentially targeting $115,000. For Ethereum, the $3,800 level is crucial support, with resistance at $4,200. The ETH-BTC ratio is showing relative strength, suggesting Ethereum might outperform if the overall crypto market stabilizes. Volume will be key for all major cryptocurrencies. Look for volume confirmation on any breakouts or breakdowns, as low volume moves are more likely to reverse. Common mistakes and how to avoid them. Let me share some of the most common mistakes I see traders make when reading crypto charts, along with how to avoid them. The biggest mistake is trying to use too many indicators at once. Professional traders typically use 3 to 4 indicators maximum, focusing on different aspects of market behavior. More indicators don't make you more accurate. They often create conflicting signals that lead to paralysis. Another common error is ignoring the overall trend. Remember, the trend is your friend until it's not. Don't try to pick tops and bottoms. Instead, trade in the direction of the prevailing trend and let the market tell you when it's changing. Finally, many traders fail to adapt their strategies to changing market conditions. What works in a bull market might not work in a bear market. Professional traders constantly evaluate and adjust their approaches based on current market dynamics. Building your trading plan. Before you start applying these techniques, you need a comprehensive trading plan. This isn't just a suggestion, it's absolutely essential for long-term success in crypto trading. Your plan should include your risk tolerance, position sizing rules, preferred timeframes, indicator settings, and clear entry and exit criteria. Most importantly, it should include rules for when not to trade. Sometimes the best trade is no trade at all. Professional traders also keep detailed trading journals, recording not just their trades, but their thought processes and emotional states. This helps them identify patterns in their decision-making and continuously improve their performance. Conclusion: your journey to professional chart reading. As we wrap up this comprehensive guide to reading crypto charts like a professional, remember that mastery comes through practice and continuous learning. The techniques we've covered today are used by the most successful traders in the world, but they require time and dedication to master. Start with the basics, understand candlesticks, support and resistance, and simple moving averages. Then gradually add more sophisticated techniques like multi-time frame analysis and advanced indicators. Most importantly, always prioritize risk management over profit maximization. The crypto market will continue to evolve with new technologies, regulations, and market participants constantly changing the landscape. But the fundamental principles of technical analysis, understanding market psychology through price action, will remain relevant regardless of these changes. Remember, every professional trader was once a beginner who felt overwhelmed by charts and indicators. The difference between those who succeed and those who don't isn't intelligence or luck. It's persistence, discipline, and a commitment to continuous learning. If this episode helped clarify the world of crypto chart analysis for you, smash that like button, subscribe for more professional trading insights, and ring the notification bell so you never miss an episode. Drop a comment below with your biggest chart reading challenge. I read every single one and often create content based on your questions. Until next time, this is Bonnie reminding you that in the world of cryptocurrency trading, knowledge isn't just power, it's profit. Stay smart, stay disciplined, and I'll see you in the next episode where we'll dive deep into advanced risk management strategies that could save your portfolio.